Hey everybody, it's Seth and Paul with the Everything Money channel. Today we analyze Dick's Sporting Goods stock. It is rising. It is up. People are working out at home.
Up 15% today.
Up 15%. What's going on? Paul will analyze the company from top to bottom, financials, cash flow, PE ratio, all of it right now on the Everything Money channel. Let's go. Paul, the last time we talked about Dick's Sporting Goods stocks, we were talking with my 9-year-old son. He still hasn't invested a lot of money, but
he has not.
He has been staying out of the market with his money. He sold his Tesla at around 900, but
what an idiot.
Yeah, of course. He said he liked Dick's. I think he just likes going in there because it's filled with like Browns and Indians gear. He just it's like a kingdom for like local. But it is retail, Paul.
It's retail. And it's a big store in retail.
I would be assuming that it's not doing well, but I brought it up because it looks like the stock might be doing better because people are working out at home. A new trend, obviously, with coronavirus. Is the
stock doing better? Are you saying the stock is doing better?
Yes, the stock is doing better. That was a Market Watch article I read. So let's do this. Right now, Paul's going to use his 8 metrics, his 8 pillars of analyzing a company, the health of a company, to see if the stock is worth buying at a good price or not. Let's start, Paul.
Let's start first.
Go on.
Buy.
Take a moment to like the video down below. Smash that like button, pretty please. Paul's look dashing. Paul thinks his muscles look really good, so comment below on his abs and biceps.
It's not abs. I need to work on the abs. I got a little spare tire right
I
here.
tell him that he's dead sexy, but he still thinks he's got a little flub around the middle.
I do. I have a
but
little
regardless,
spare tire right here.
Paul, what is the first foundational pillar that you look at when looking at a company's stock price?
The revenue. So we're going to look up Dick's, and I go to my Y Charts account.
Mm-hmm.
You can find this anywhere, Google Finance, Yahoo Finance, anywhere. It's all free. You can go to the company website. They'll give you all the history of their financials.
So let's look at the revenue growth over the past 5 years, Paul.
Okay. So revenue growth of the last 5 years annually. The revenue growth.
Tell it to me.
In 2011, what did they do in revenue? Can you see that?
4 something.
4.9 billion. 5.2, 5.8, 6.2, 6.8, 7.3, 7.9, 8.6, 8.4, 8.7.
Good consistent growth.
So it's good consistent growth. I don't know what's caused that. Have they made acquisitions? Have they done things? I'm sure there's some acquisitions along the way, but they have good, steady, consistent growth, especially in the world of internet. One of the things I want to know is what percentage of their revenue has been internet-based over the last 10 years, right? We want to know that. Foundation
pillar number 2. Is profit growth over the last 5 years. We did 10 years.
Growth.
We did 10 years for growth, but
yes.
Show me 5 or 10.
Okay. So, over the last 10 years, 182 million, 264, 290, 338, 344, 330, 287, 323, 320, 300. So, It's grown, but in the last 5 years, we haven't seen any growth. We've actually seen declining profit. Kind of a red flag. I want to know, how is revenue growing that much, but profit's going down? That's not a good thing. So we have to figure that out and, go about that way.
Pillar number 3 is free cash flow
Okay.
growth.
Uncle Seth, what am I going to ask you right now?
What is free cash flow?
What is free cash flow?
Oh, God. Current holdings?
No.
Go on.
It's your cash from operations.
Cash from operations.
Less your
expenditures.
Capital expenditures.
Capital
Which is your investment back in your property, plant, and equipment, that kind of stuff.
Cash from operations.
So the cash you make from the actual business, less how much money you invested back into your business.
Free cash flow.
Yep.
Go ahead.
So 10 years ago, it was about 220. Then 210, 209, call it. Then 219. Then 118. Then 250. Then 280.
No, this is okay, right?
No, this is getting better.
Okay.
It's getting better, right? 220, 209, 219, and one small year, then a growth back up to growth again.
Okay.
Then 340. Then 280, call it. Something like that. Then, 500. And then last year was, ending in January, was 180 million. So they had a lot of growth. This last year was pretty bad.
Okay.
And the last year ended before COVID hit and the recession hit. So I'm going to be like, okay, why did it drop from 500 million down to 180 million? That's a big red flag to me.
Okay.
But it had consistent growth along the way.
Okay.
Like if you'd been looking at this company last year, you'd be like, damn, look at this.
Yes, nice.
This is incredible. Free cash flow is growing.
What could have happened, you think? What are some reasons it went from 500 to
That's a
180?
good question, Seth. Why would it have done that?
I don't mean Dick's Sporting Good in general. What would happen in companies why that would go down?
Higher fixed costs, spending more on capital expenditures, but here that's not the case. It's not like their capital expenditures skyrocketed. It could just be any sort of aberration in the operations that may have occurred. Like they spent a lot of money on. Go ahead.
You said aberrations and operations. It's kind of funny.
Aberrations, operations.
Pillar number 5 is our favorite, PE ratio.
Okay, so the PE ratio. Now, I'm going to go back to the income statement here. Now, I'm going to go to last full year and then trailing 12 months.
Okay.
Because the last full year ended before the recession hit.
Yes.
It made $300 million in the last full year. Now, they're worth $4.8 billion. So what is that PE ratio? $4.8 billion divided by $300 million. I'll tell you it's 16.
Oh.
Okay.
Nice.
Now, that's before the recession hit. We want to see how have they done financially since the recession. So what we do here is then you guys have to go to the quarterly statement, not just the annual statement. Now, guys, this is where we have an issue.
Uh-oh.
Right. The last quarter, the quarter ended in July, but they haven't reported yet. The one in April, their revenues went from the same thing last year of $1.9 billion down to $1.3 billion. And they went from making $57 million down to losing $143 million. So they've lost a lot of money because of the economy. The recession hit them really hard.
Now, wait a minute. We go through 8 pillars and we're through 5, Paul.
Yep.
It sounds like everything's in a tank. Isn't this a good time to buy?
Now, so the interesting thing about retail is this a good time to buy what? What are you asking?
The stock.
This stock specifically?
Well, we always analyze companies, and all these numbers are way too high for you. It's incredibly overpriced, and so it's a no buy. So
Not all the time, but go ahead.
But so maybe I'm speaking out of turn.
Remember, everything about looking at a company is about how you're going to assess the information that's in front of you.
Okay.
Right? My comment about this company, before we get through the other 3 pillars, the rest of the 8, even taking out the recession, they're still selling for 16 times earnings. Then you have to factor in where is retail going, and you sit there and go, okay, it's not like they're a screaming deal. 16 times earnings isn't bad, but that doesn't even factor the recession in. Now, you go look at the company though, it's selling at $54 a share. In April, it was selling for $21 a share, which meant instead of $4.8 billion market cap, it was, what is that? $2 billion market cap, and all of a sudden you're like, wait a second, $300 million in profit, $2 billion market cap. That's a PE of 6.6.
Oh,
that seems like a screaming deal. Now, even if retail has a hard future, 6 times earnings and 6 times free cash flow, it's actually 4 times free cash flow at that time. That's not bad. But everything's based on the price relative to the value.
So I just noticed this went up 15% today?
Oh, I didn't even see that. You're right. It's up 15%. Why is that? Dick's Sporting Goods sales pop in first weeks of current quarter despite uncertainty over school openings. Wow, look at that.
Well, that was the I think that was the article I read, is that, like I said, people are working out at home and maybe sports are firing back up.
Yeah, a lot of everyone's working out at home. Right there, there's the article.
I'll be darned.
Dick's Sporting Goods jumping because everyone's working out at home.
Let's analyze the last 3 pillars. What about price to free cash flow less than 15?
Okay, so if you remember, the free cash flow last year was $187 million. It's currently $4.8 billion market cap. So $4.8 billion divided by 180. What is that, Uncle Seth?
26.6.
Yeah, 27. That's high. Now, the previous year, they had $500 million in free cash flow, which would have made this less than about 9.5 times free cash flow. But so for companies like this, you want to look at maybe an average of the last 4 or 5 years, maybe present value it, et cetera. Do it like the same way we do it with the 10-year cyclically adjusted PE. But it's a little pricey here at this level based on the last full year. Now, let's go on, and I'll comment after this.
Yeah, profit margin greater than 10% is pillar number 7.
So the profit margin in the last quarter was a negative because they had negative profits. So we want to sit there and go back to the financials. So we're going to go back to the financials and see what they made in the last full year. Because I do want to look at what's their regular profit margin when they're operating normally.
Mm-hmm.
So last full year, their profit was $300 million on sales of $8.75 billion. So 300 divided by 8.75 billion. What is that, Seth?
3.4.
3.4%. Now this is retail. They tend to have lower margin. The gross margin tends to be better, but 3.4% of the bottom line. What did they do in previous years? About the same. They never really got into double digits. Is that a game deal breaker for me? No, because it's retail. But I like to see 10%. But let's go to the last one.
Last one is decreasing share numbers.
Okay. Average shares outstanding. In 2011, they had 116 million. Today, they have 88 million.
Going down.
Going down. So they're buying back shares, using their free cash flow to buy back shares. So overall, here's my take on Dick's overall. I'm not a no on Dick's. I'm not a yes on Dick's. I need to go understand things more thoroughly. I need to see what are they doing in their online sales, because that's their biggest competition right now is going to be Amazon crushing them. Now, I will say this. When I buy shoes and sporting goods, I do not go to Amazon.
Me neither.
When I buy clothes, like this shirt, I did not go to Amazon. I go to Dicks.com.
Yeah.
I buy from Dick's. That's my personal opinion. So I don't know why that is.
Me neither.
I never go to Amazon for these things. So we have to understand the business. How are they going to adapt? Their stores are very large stores. So I want to understand, are they opening stores? Are they closing stores? If they're closing stores, what kind of stores are they closing? This is the second level of just taking the pillars and saying the pillars aren't going to answer enough. I've got to understand. The good news is I'm not a no on Dick's. How many check marks do we have? How many X's do we have?
2, maybe?
Not check marks? No, we had more than 2 check marks.
We have PE. Oh, I'm sorry. Revenue growth was good.
Yep.
Profit growth was okay. Free cash flow
was good. It was pretty decent, even though it dropped in last year, but it wasn't terrible.
PE was good. What about assets over liability?
Oh, we didn't do that one.
Current assets over current liabilities.
In retail, it tends to not be good.
Okay.
Total current assets. We'll go to the most recent quarter because I want to see that. How are they going to look? How they look most recently? Total current assets, $3.8 billion. Total current liabilities, $1.88 billion.
They got tons of money.
Yes, a ton more than their liabilities. That is great. Another check mark there.
So go back to the stock. Go back to the quote here. The question is, Paul, did we already miss the boat?
Maybe we did. I do agree with you. I don't think $55 is a reasonable price.
Will you pull up the 3-month or 6-month? Yes. Look at this.
I don't think that $55 is the right price. But I don't know how far off we are. We could be $50. I don't know. Because the question is, how quick will they get out of this COVID problem, the current recession, and what's their plan for occupying more market share online? Right now, so let's look at it this way. This is a very good metric to know. Internet sales. So one of the most important parts is I want to understand how are internet sales, how is Dick's going to try to get more internet sales?
Yes.
If you look right here, this is the last 3 years of retail sales relative to e-commerce versus total retail. 2017, it was 4. So, Seth, if you pull out your calculator real quick.
Yeah, please. Yep.
461 divided by 3484.
I'm sorry, what are the numbers?
461 divided by 3484.
3484. 13%.
On the nose?
13.2.
13.2%. Okay, next one is 524 divided by 3626.
14.4.
Okay, the last one is 602 divided by 3763. Bless you.
37 what?
63.
602 divided by 3763. 15.99.
Okay, so 16%.
Yeah.
So as you can see in the last 3 years,
What is going on here again?
this is internet sales as a percentage of all retail sales.
Oh, it's going way up.
So it's going up. In 2000, when we were in college, it was like 0.7%.
Wow.
So the question becomes is, how are they going to grab more and more of the retail? Because obviously online is becoming bigger and bigger and bigger and bigger. Does that mean Dick's Sporting Goods should shut down all its stores? No. They're going to be able to have stores. People still do you still like going shopping?
I mean, isn't the funny internet meme with moms is like going to Target, like you go in for milk and you come out with a whole cart full of Halloween goods and...
Well, somebody told me recently like malls are all dead. I'm like, no, not all malls are dead.
Yeah.
But bad malls will be dead. But people still like going, I still like going shopping.
Sure.
Lisa and I like going to the mall. When we go on a trip, we like just walking around shopping, maybe just like walking and looking at stores, shopping, things like that. This is just a reality of life, though. The economy is changing. How we buy is changing.
Yes.
The question to me for Dick's is, how are they changing along with it? They've got a lot of big stores. Are they just going to, is there a long-term plan to sit there and say, listen, we have a bunch of leases coming to due in the next 10 years. Our goal is to get out of the ones that aren't making us as much money. And as time goes on, focus our online shopping. Great. I'm still going to go to Dicks.com. Even Amazon owns like half of the e-commerce market. Okay, great. Then, or something crazy like that.
Yeah.
How do they sell on Amazon? Maybe they go to Amazon and say, listen, we want to become your official retail sports store. I don't know. Whatever it is, you got to understand that before you make an investment in Dick's Sporting Goods.
So you're not buying Dick's?
No, I'm not saying that. I'm not buying or not buying. I'm sitting there saying I need to do a lot more research on it. I am saying that. But at $20 a share, I'm buying.
Right.
When it was in March, and I should have been pay more attention. The question is the online sales. That's the question.
Thanks, Paul, for the analysis. Follow along with the Everything Money channel while we analyze. Write us some stocks below if you want to hear, or are we missing something? Paul will analyze with his 8 foundational pillars of health for a growth company.
And we won't skip one of them next time.
Yeah, this damn host. Thanks for joining us. Like below, subscribe. Everything Money channel with Seth and Paul. Love you guys. Appreciate it.